Well, welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, we are staring down a big week.
A big week. You've got central banks announcing their decisions, the Fed, the BOJ, the BOE, among others.
And we also have earnings, so it's going to be a lot of fun. But let's right now get to the biggest stories right now in the more than $12 trillion global ETF industry. And we start, of course, with the spot Bitcoin ETF frenzy. It persists with record-breaking flows. And, of course, the token itself off record highs, but pretty close as some worries persist about a possible bubble.
And we'll continue the crypto conversation with Grant Engelbart of Carson Group, which just approved 4 spot Bitcoin ETFs on its advisory platform.
Plus, the income ETF boom, it's hitting Wall Street. We're going to drill down into one fund with Thomas Campbell of SCF Management. But as always, before we get there, Eric Balchunas from Bloomberg Intelligence. He's here with us now, taking a look at the flows. Eric, hit it.
Katie, Scarlett, thank you very much. And the flows are very bullish. I mean, really, it's almost super bullish. Our big theme this year is people are comfortably bullish, but I'd say we're almost getting above that now. Look at the top ETFs here. SPY with 7.5 billion, VU with 4.8, and IVW with 4.4. IVW is really interesting. This is the BlackRock model, which is gigantic, and it's rotating into growth. So it's actually wanting to actually own growth stocks and tech. CAL's also, that's tax related, but CAL's has been having a great year. Bitcoin, again, always in the top 10, it seems like lately, with a lot of flows. But that 1 week at 59 billion is crazy, right? So in March already, we're at 75 billion with 2 weeks left into equity ETFs alone. If we got, obviously double that, that would just blow away the record. That's how strong the flows are. Let's look at the outflows. And there is a couple things here that are maybe not worrying, but IVV, now that's money out of IVV into the growth. So I wouldn't call that bearish at all. HYG, maybe that's a risk-off trade there. GBTC, that's also part of that Bitcoin story. And ESGU, BlackRock, again, continuing to pull money out of ESGU. More bad news for that trade. Let's go to the crypto world and the Bitcoin ETFs in particular, just to give you an idea of where they're coming from and where we're at right now, right? So if you look, this is when GBTC existed, right? Nothing. Then the Bitcoin ETFs get approved. Okay, there's a lot of hype. First 3 weeks are pretty big. Then there's a little bit of a drop-off. I thought we'd live here for a while and I could get on with other things in my life. But then, boom, this second wind came up. They've taken in 2.5 billion 2 weeks straight. And last week, they traded $35 billion in volume. So this month alone, they've already doubled their February volume. This is really quite something. Normally, you have a hype, it goes down. But this kind of come back up is unusual. And again, I can't take my eyes off it.
Yeah, the re-acceleration in trading volume, as Eric says, it has just been stunning to watch. So let's keep this conversation going right now with Grant Engelbart. He is Vice President and Investment Strategist over at the Carson Group. Grant, it's great to have you with us. I want to start with news I actually broke about your company last month, and that, of course, is your $30 billion platform greenlighting 4 of the 10 or so spot Bitcoin ETFs out there. Of course, we're talking about BlackRock, Fidelity, Bitwise, and Franklin Templeton. So let's start there. What does the due diligence process look like when it came to onboarding just 4 of these ETFs?
Well, we wanted to get the due diligence process started early. So we've been talking to these issuers through the filing process, through the last minute fee reductions and all of the things that Eric has been following for the last several months to start the process to understand custodial relationship, the ETF structure, which the SEC essentially settled on behalf of the issuers. We understand the crypto native kind of components of these firms, how their experience trading crypto with other providers for years prior to this, the infrastructure in place to safeguard, safekeep assets, and of course the custodial insurance relationship we think is really important in this case as well.
Thank you for listing out those criteria. Which did you give the most weighting to?
Well, I forgot to mention price, which is also, we think, ultimately tracking a single asset over time. Price will be important. It's not everything, but we did give a good weighting to price, asset growth, institutional adoption to the extent that we can tell there's institutional adoption so far, and also just the crypto native aspect of the firm. Like, how committed are they at a firm level to making Bitcoin ETFs work, making cryptocurrency work, and being a sponsor of digital assets to the broader ecosystem.
And Grant, if you could, talk a little bit about how advisors are able to put clients into this, right? Explain the solicited versus unsolicited investment into these and how that's playing out so far in the first, 2 months.
We have a limited, kind of curated, I guess would be the way to say it, ETF platform. So we've got about 10% of all available ETFs on our platform. And I don't mean that in a negative way, but that's currently what we allow our advisors to use within our technology tools to allocate accounts. So that being said, we settled on 3 or 4 Bitcoin ETFs to be available initially. Making all 10 available would put us on par with large cap blend ETFs, and that just didn't make a ton of sense for us. So we wanted to give our advisors options, differentiation, but also not overwhelm them with a ton of choice. And that's why we settled on the 4 names for now. We'll continue to look and evolve that if need be as the space evolves and as we continue to see these massive inflows. We do want to see stress events as well, hit the market, not necessarily for clients, but for the ETFs themselves, and see how they react, see how the trading partners react to a 24/7 market that only trades in form of the ETF during the U.S. stock market trading day.
Grant, I want to talk a little bit about the timeline here. Of course, you onboarded these ETFs about a month or so after they launched, a little more than a month after. Is that unusually quick when it comes to brand new ETFs?
It is. In this case, we wanted to act quickly. We have a due diligence committee that meets every week. We meet as an investment team 3 times a week. And so we felt we were in a place to be nimble and allow our advisors to get access to these products as soon as we could, but also do the proper thorough due diligence on the underlying. And so we were able to get them out about a month after launch, which gave us a good amount of time to kind of get a read of where product and asset flows are going to go. And we've seen interest. To Eric's question, we have seen a handful of advisors allocate on average 3.5% to client households. Of course, that's an average with a range and generally in more aggressive accounts. And we over-communicated that aspect of things as well, trying to communicate with clients about what these products actually are and also how to use them in portfolios appropriately.
So for those investors interested in the Bitcoin ETFs that you offer, are they deploying new funds, or are they cashing out of other assets on your platform to raise funds to buy the Bitcoin ETFs?
Great question. To the extent we can tell, it's usually coming out of an already allocated portion of their stock side of the house. So usually a growth allocation or more aggressive all equity exposure is what we're seeing move into the Bitcoin specific allocation, again, at a small weight, sub 5%, which is right on where we've been kind of preaching to advisors. So we aren't necessarily seeing new money that wasn't in the market go into Bitcoin, but we are seeing that kind of aggressive portion of the allocation rotate over to keep risk lined up.
So Grant, one thing we've noticed in the flows is that there's like a polarization. A lot of money goes into cheap beta, or the very opposite, stuff that I describe as hot sauce, right? Like ARK, thematic ETFs. This is a way to sort of scratch your speculative itch. I know advisors have this problem with clients. They want to have a little fun and speculate. To me, the Bitcoin ETFs go in there. As somebody who's gatekeeping this platform, how much like hot sauce type ETFs do you allow on the platform? Or is this like unusual for you or normal?
I wouldn't say unusual. It's normal. We do want to limit that exposure, and we do have some quote unquote hot sauce ETFs. But where we have focused more of our attention is on active ETFs, broadly speaking, and that ranges, of course, from we have a lot of traditional financial advisors on our platform. We're used to seeing active strategies in a mutual fund wrapper, and now the education around these are available in an ETF wrapper in a better form that's not going to hand you a capital gain every single year. That's really where we've seen a lot of that attention. We do want to limit the amount of high tracking error strategies on the platform, to your point, but we have seen this barbell as well, honestly, between money market and short-term fixed income, and then Bitcoin growth AI on the other side. Hopefully some diversification in between, but we definitely have seen flows in both of those areas in kind of a bifurcated nature this year.
Well, Grant, we don't have much time left, but I do want to talk about a Bitcoin-specific event that's coming up, and that, of course, is the halving or the halvening, however you choose to pronounce it. But how would you expect that to impact the trading of these spot Bitcoin ETFs?
It's another question that I think is worth really thinking about. As it sits today, there's a lot of attention to the halving coming up as a price, sending price higher. The supply and demand mismatch that comes with that. But one thing that we really want to pay attention to is if that impacts Bitcoin transaction costs. At the end of the day, there is still an underlying market that needs to be transacted in, and that's the Bitcoin market, and that trades, again, 24/7 around the world with various exchanges. not just US-based exchanges. And so if there is an impact on transaction costs of Bitcoin itself, which is related to the hash rate and the number of miners involved in the process, that could have an impact on the ETFs themselves. So we're watching that very closely. And that's something through the due diligence process we wanted to talk with our providers and ensure that that's something they were watching as well.
Grant, great speaking with you. Appreciate your time on this Monday. That, of course, is Grant Engelbart of Carson Group. Now coming up, with the mega launch of spot Bitcoin ETFs in the U.S., some of the older crypto funds, they're now getting left behind. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with physical Bitcoin. Of course, we're talking about gold here and taking a look at GLD. This is State Street's physical gold ETF. And you can see the price has been rallying pretty significantly over the past month or so. Haven't really seen a lot of love in terms of flow until last week, taking in over $1 billion on a single day. That is the biggest one-day inflow since early 2022. So some love for the yellow metal. A lot of love, too, when it comes to Taiwan's stock market. You're taking a look at Taiwan equity ETFs here, and you can see that the flows in 2024 have been very significant so far. Already, we're at half of 2024's total flow. So we'll see that if that momentum continues as we get deeper into 2024. Let's also go back to what we talk about every show, and that is Bitcoin ETFs. You're taking a look here at year-to-date flows for some of these legacy Bitcoin ETFs products. Rather, we had the U.S.-listed spot Bitcoin ETFs launch in January, and since then we've seen Canada, Germany, and Sweden see year-to-date outflows as investors really rotate towards the United States.
All right, Katie, let's talk more about this with Bloomberg's Isabel Lee. Isabel, when we look at countries like Canada, Germany, and Sweden losing some of their assets from their Bitcoin products, do we know what kind of investors are pulling money out of there?
So it's always hard to tell when it comes to ETFs, but a hunch would probably tell you maybe retail or actually even institutional, because at the bottom of it is really the fee war. Because, for instance, if you look at the Canada one, a big part of that is the Toronto-based Purpose Investments, and they charge 1%. And that comes close to GBTC, which charges 1.5. But the rest, if you remove that in the US, the average is around 25 basis points. It really comes down to going for the cheaper alternatives. And if you look at the top three, Germany, Canada, and Sweden, yes, it's around 738 million that investors pulled out. That's a quick mental math there that I did.
Very impressive.
Yeah, I definitely could not do that, but I could remember Sweden. So, okay, so that's the sum so far. How has that evolved? Or are we seeing that accelerate, slow down? What does that actually look like?
I think it's going to accelerate. And if you look at that year to date, it's kind of significant because these aren't really large funds per se. And I feel like people always talk about the spot Bitcoin ETFs in the US, forgetting that these funds have existed elsewhere, namely those three countries. But US is the biggest market, and I think what's really impressive is how cheap it is. And we've seen some of these ETFs even charge 0 basis points up until a certain extent or a certain date. And that just really shows you how vicious the cycle is. But I guess investors benefit from that.
Well, the fee war continues. Any sense of how far along that process we are? I mean, if you think it's going to accelerate, are we in, still the first half of this, or is there, we're already 2/3 of the way through this process?
I think we're not yet 2/3 for sure, because we have a lot of institutional investors still holding out, and they're waiting, should we jump in? And they're seeing, okay, we'll see which of these ETFs we'll choose, because again, in the US, there are 10.
Yeah.
But you look at the leaders, it's just really 4, or if you really want to be particular, it's just really BlackRock. It's 12 billion. Fidelity used to be a close second, but now it's just half, 6 billion in assets. So I think that the winners are really emerging. Yeah. I don't want to call the others a loser, but you could just see the trend. People are just focusing, out. Yes, they're focusing on just a few.
All right, Bloomberg's Isabel Lee, thank you so much. And of course, check out Isabel's story on the Bloomberg at Bloomberg.com. Still ahead, we're going to drill down into the income ETF boom with Thomas Campbell of STF Management, who has his own fund. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Today, Katie, we're looking at Tuggin, which is the STF Tactical Growth and Income ETF, sort of part of the covered call movement that's been very popular. The idea here is you go long an index, write some call options just out of the money. So if it goes up, you give up your upside, but you get a lot of income from those call options that is like yield. So it's actively managed. It's going to use momentum and volatility. It can actually deviate from holding the NASDAQ fully. It can hold it a little bit, so it won't be always into the NASDAQ 100 100% of the time. 65% or 65 basis points is the fee. That's, a little more than the JP Morgan one, but within a reason. And then the market cap is 43 million. So it's pretty new, about a year old. Let's look at the yield, which is what everybody is looking at with these. And it's big, 11%. That is more than JEPI and JEPQ. JEPQ is about 9%, which would probably be its main competitor. And the one-year return, very good. Let's actually hone in on this return and compare it to JEPQ and the S&P 500, just to get an idea of how this has returned over the past year. And you can see this thing is up a lot. So 33%, it's a good return. But, versus the others, it's right in the mix. I mean, it's give or take, about 2 percentage points, JEPQ and SPY there. One thing, though, see how much of the return comes from the yield on Tuggin? It's like half, right? It's a little less than JEPQ, which means that it'll have a little more buffer in a downturn. So you can see it right here, the white line. It's going to have a little more buffer than JEPQ, but they're really close. So Katie, just another ETF that's trying to take part of the covered call craze.
All right, Eric, thank you. And joining us now to talk about this ETF is Thomas Campbell. He is co-CEO of STF Management. And let's talk about really the portfolio allocation, because my understanding is that you pivot between equities and bonds. What does that decision look like?
So the decision looks like, as he mentioned, it is a momentum and a trend indicator that we follow. It's proprietary. I developed this back in 2015 for an SMA business. I was introduced to Jonathan Mulchin, who's the other co-CEO, who brings a decade of this options income ETF experience to the table. And what we're doing is matching up the ability of TUG to manage the exposure to equities, being long when you should be, being someplace else when the markets are not favorable to equities. And we have those 3 steps. We're 100% long the NASDAQ 100, so we're tracking with it right now this year. But we can be as little as 10% in equities, 90% in government bonds. And it is that downside risk management that we capture through the allocation process as opposed through the options writing process that we think gives us an advantage.
So what is the split right now between equities and bonds, and how do you expect that to change once the Federal Reserve does start cutting interest rates?
Actually, our split right now, we're 100% equities, and we have been basically since November. So our system is indicating that there's no reason to take a look at bringing in fixed income. And I would argue that given the 1982 experience, that when the Federal Reserve in 1982 cut interest rates, not because we were in an impending recession, but because they recognized that they were restrictive at that time, the markets exploded. The S&P 500 would be up over 56% in the next 12 months, but that first 2-month period of time, it would jump over 31%. I kind of feel like that narrative has a chance to play itself out this year. So our hope is that any volatility between now and then does not reduce our exposure, and we're able to capture that initial wave. Because if you're a surfer, you can't catch the wave after it's gone by you. You need to be in it before it happens.
And I want to ask you a question about the covered call movement. As I said, it's a craze. I mean, there's many ETFs that are doing this now. They have different names, but they all essentially are covered calls. This idea of writing call options, in terms of the options market underneath, what percentage of these ETFs make up the whole options market? And is there any worry about a crowded trade, so to speak, sort of like maybe we had shorting VIX futures back in 2018?
You're right, where everybody was on one side of the trade and it all did itself at the same time over a weekend, right? There is obviously in the options income side of the house, I would say most of the volume is still in your basic buy a put and a call combination. We do a call spread option, which is a little bit more unique. There isn't as much volume in that right now in the options income side of the house. And ours is active. It's not passive. So again, go back just a little more than a decade. The first of these ETFs come out with a passive underlying base, an index, an equity index of some sort, and then basically a buy and a call. My partner became much more active in the late 1910s, so before the 2020 opportunity, and again sat there and said, look, why are we holding these options, to your point earlier, which caps our gains? And so by being more active in that, we can reduce the impact of carrying a short with us in a rising market. And now we have active on both sides, an active underlying base, which allows us to focus on that call spread option that really just to say we're trying to hit that 100 basis points of yield or distribution on a monthly basis. That allows us to be, I think, far more efficient than the other options programs out there. I don't feel like we are per se as an ETF firm in the crowded side of the trade.
And Thomas, I want to talk a little bit more about the covered call craze that Eric described. And I think it was Bloomberg Intelligence that called these income ETFs boomer candy. Let's extrapolate on that. Who is this ETF for? Is this appealing to the older investor?
I will tell you, I have an older investor who is thrilled with this, because if you go back to an SMA sort of a day, your Carson interview hit on this as well. If you're buying a mutual fund, you're buying an SMA, something along these lines, because you're looking for risk management, you're always handed a big fat 1099-B at the end of the year. The active ETF space allows us to make our trades, and we don't make many, maybe 3-4 in a given year over long span of time. But every one of those trades is now short-term in nature. And so if you live in the wrong state, you get taxed a couple of different ways. You're exactly right. This is a person who's wants their yield and wants growth at the same time. That was what they were promised in retirement, a growth in income strategy. And so now if he only has to recognize the yield side of the house and the growth can continue to defer and move forward, he's in a much better place. And so I 100% agree with you. I do think this is sort of boomer candy. At the end of the day, most of what our industry has to offer people is essentially some sort of an annuity product where you may get a good yield or a good income stream, but you don't really get much growth. Now, an opportunity to do both, and that's what they've been waiting for.
All right, Thomas, really enjoyed this conversation. Got to leave it there. Hope to speak again soon. That, of course, is Thomas Campbell of SCF Management. And if you just can't get enough of ETFs, a reminder that, of course, you can listen to Eric and Joel Weber on Trillions. It's their podcast that covers the industry. But sadly, that does it for Bloomberg ETF IQ, at least for now. I'm Katie Greifeld, along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.